Let's move on and let's talk private credit because, well, the asset class is becoming increasingly popular. So what's driving this? Patrick Prasad is the Managing Director at Rixon Capital, an investment manager specialising in SME private credit strategy. Joins me at the desk. Patrick, thank you so much for joining us today. It's really wonderful to have your company. So that sort of core question, that key question to start with, why do you think investors are increasingly interested in private credit?
Yeah, look, there'll be two key drivers, Kyle. One that's really helping the space at the moment is the flight of investor capital away from the listed equity markets. Because you get high returns and there's a bit of volatility, but it's come to a point where that volatility is hard to stomach for a lot of investors, and the yields aren't as attractive on those dividends anymore. Second is the fact that an allocation of private credit can actually offer you a absolute CPI plus return. Because to use the Rixon example, our target return is 10 to 12%. We only write loans that deliver no less than 13%. Therefore, you get no less than 10 to 12. Whereas with an equity strategy, the fund's actually chasing a volatile variable benchmark. The benchmark's up 10%. You're hoping you're getting 12. If it goes up 30, it's 35. So if you haven't got that certainty in a market that's reasonably uncertain, people love that absolute return.
Just staying on that point just for a moment, and this idea that it is becoming increasingly popular to invest in private credit, I guess it necessitates that at one point in time perhaps there wasn't a popularity there, and the maybe lack of popularity there was because of a lack of knowledge or perhaps a lack of an ability to be able to get invested in the space. So how do you sort of see investors' attitudes and appetite changing for private credit, and what might be driving that?
Yeah, look, that's a good question. So private credit as an asset class in Australia, as a mainstream asset class, it's only been around for about 5 to 6 years. So you're right, when it began, there was a lack of awareness. Over time, that awareness has increased. And as the wealth managers get their heads around it, we're beginning to be able to access what I call the advised market. And through friends and family, through the media, through general press and research, more and more unadvised wholesale investors are realizing this is a really good allocation for their portfolios.
Yeah, it's an interesting dynamic. So, as investors, one, get across this asset class in general and then also learn how it can sort of behave through different stages of the cycles, especially in this environment. What do you think needs to be kept top of mind for investors right now?
Yeah, look, investors need to understand what their risk-reward profile is and what the funds actually do. I think a real challenge in the market at the moment, and we spend a lot of time doing investor education as well, is don't get taken by headline return. Whether it's 6% or 15%, the return is what it is, but it's about a risk-reward proposition. So my advice to investors is always read the information memorandum, actually understand what sort of loans your fund manager is looking to write and what sort of risk you're taking. So if your fund is delivering 10% on an asset-backed portfolio, that's a reasonable return. But if it's a fund that permits unsecured lending and mezzanine lending, which is reasonably high risk, that 10% return is relatively unattractive if things ever go south because you've actually dusted your capital.
So any other emerging risks that you think investors need to be wary of as well when they're investing in this asset class?
Well, that's a very controversial question. There are actually two in the market at the moment. There's performance risk and reputational risk.
Yep.
So in terms of performance risk, you've got the large mature funds that have had large allocations into consumer discretionary lending and unsecured business lending on fixed rate terms. So this is when rates was near zero. So you're getting a lower return than you should because these funds, loans are still outstanding, but you're also exposed to an asset class that is, put it very shortly, is in trouble. So a lot of these funds are actually in workout with a lot of their loans, but they haven't registered a default or registered a write-off yet. But it's there in the books and it's smelling pretty bad. So there is that risk that investors in the funds or looking into the funds need to understand what those exposures are before they make an allocation.
And again, this is coming from someone who's never had a practical exposure or invested in the space myself, but when we're talking about, providing or extending credit to SMEs effectively, you just touched on it then, but in terms of being able to assess financials, determine the health of maybe some of the constituents of the assets that you're investing in. Is there a level of transparency around, again, that sort of information? Can an investor get that information for themselves?
It's a challenge for the investors to get direct access. So at the end of the day, the investors are banking on the fund manager having the experience and the skills and the trust that they are diving deep into the financials as opposed to taking a headline number and going, this looks fine, we'll give them capital.